School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 2 Cost Accounting, Unit 7 Absorption and Marginal Costing.
The aims of this unit are to familiarize you with the techniques of absorption costing and marginal costing, to explain the basic features and in that process bring out explicitly the differences between the two techniques, and to develop an appreciation that marginal costing has an edge over absorption costing as far as managerial decision making is concerned. Introduction. In the preceding unit, we familiarized you with the different elements of cost, that is, materials, labor, and expenses. These elements of cost can broadly be put into two categories: fixed and variable cost. Fixed costs are those which do not vary but remain constant within a given period of time in spite of fluctuations in production. The examples of fixed cost are rent, insurance charges, management salaries, etc. On the other hand, variable costs are those which vary in direct proportion to any change in the volume of output. The cost of direct material, direct wages, etc. can be put into this category. The cost of a product or process can be ascertained using the different elements of cost by the two techniques. And these two techniques are number 1, absorption costing, and number 2, marginal costing. Absorption costing. Absorption costing technique is also termed as traditional or full cost method. According to this method, the cost of a product is determined after considering both fixed and variable cost. The variable costs, such as those of direct materials, direct labor, etc., are directly charged to the products, while the fixed costs are apportioned on a suitable basis over different products manufactured during a period. Thus, in case of absorption costing, all costs are identified with the manufactured products. This system of costing has some disadvantages. Number 1, it assumes prices are simply a function of cost. Number 2, it does not take account of demand. Number 3, it includes past cost which may not be relevant to the pricing decision at hand. And number 4, it does not provide information that aids decision making in a rapidly changing market environment. The technique of absorption costing may lead to rather odd results, particularly for seasonal businesses in which the stock levels fluctuate widely from one period to another. Their profits for the two periods will be influenced by the transfer of overheads in and out of stock, showing falling profits when the sales are high and increasing profits when the sales are low. The technique of absorption costing may also lead to the rejection of profitable business. The total unit cost will tend to be regarded as the lowest possible selling price. An order at a price that is less than the total unit cost may be refused, though this order may actually be profitable. Marginal costing. The technique of marginal costing is a definite improvement over the technique of absorption costing. According to this technique, only the variable costs are considered in calculating the cost of the product, while fixed costs are charged against the revenue of the period. The revenue arising from excess sales over variable cost is technically known as contribution under marginal costing. Absorption costing and marginal costing differences. The difference between absorption costing and marginal costing is based on the recovery of fixed overheads. The difference in the valuation of inventory under the two techniques is a consequence of such treatment. However, for the sake of clarity, we are analyzing the difference from angles and recovery of overheads and valuation of stock. Recovery of overheads. In the case of absorption costing, both fixed and variable overheads are charged to production. On the other hand, in marginal costing, only variable overheads are charged to production while fixed overheads are transferred in full to the profit and loss account. Thus, in case of marginal costing, there is under recovery of overheads since only variable overheads are charged to production. Valuation of stocks. In absorption costing, stocks of work in progress and finished goods are valued at works cost and total cost of production respectively. The works cost or cost of production is defined as including the amount of fixed overheads. In marginal costing, only variable costs are considered while computing the value of work in progress or finished goods. Thus, the closing stock in marginal costing is undervalued as compared to absorption costing. But this does not result in carrying over of fixed overheads of one period to another as it happens in absorption costing. There are some general rules that should be kept in mind. Number 1. The profit under the traditional costing system and the marginal costing system will be the same if there are no opening and closing stocks. Number 2. If there is closing stock and no opening stock, the profit under the traditional costing system will be more than marginal costing system. Number 3. If there is opening stock and no closing stock, the profit under the marginal costing system will be more than the profit under traditional costing system. And number 4, suppose the quantity of closing stock is more than the quantity of the opening stock, presuming that both opening and closing stocks are valued at uniform prices. In that case, profit under traditional costing system will be more than the profit under marginal costing system and vice versa. Marginal cost. The technique of marginal costing is concerned with marginal cost. It is therefore necessary for you to understand the term marginal cost correctly. The Institute of Cost and Management Accountants, London, has defined marginal cost as the amount at any given volume of output by which aggregate costs are changed if the volume of output is increased by 1 unit. On analyzing this definition, we can conclude that the term marginal cost refers to an increase or decrease in the amount of cost based on the increase or decrease of production by a single unit. The unit may be a single article or a batch of similar articles. Let's understand this with the help of an example. A factory produces 500 tricycles per annum. The variable cost per tricycle is Rs 100. The fixed expenses are Rs 10,000 per annum. So the cost sheet of tricycles will appear as variable cost, which will be 500 into Rs 100, that is Rs 50,000, and fixed cost is Rs 10,000. So the total of this cost sheet will be 60,000. If production is increased by 1 unit, that is, it becomes 501 tricycles per annum, so the cost sheet will then appear as variable cost will be 501 into Rs 100, that is Rs 50,100, and we will add fixed cost of Rs 10,000 to it, so the total will be 60,000 100. Hence, the marginal cost per unit is rupees 100. Marginal cost ordinarily is equal to the increase in total variable cost. Within the existing production capacity, an increase of 1 unit in production will cause an increase in variable cost only. The variable cost consists of direct materials, direct labor, variable direct expenses, and variable overheads. The term all variable overheads include variable overheads plus the variable portion contained in semi-variable overheads. This portion has to be segregated from the total semi-variable overheads according to the methods which we will discuss later. The accountant's concept of marginal cost is different from the economist concept of marginal cost. According to economists, the cost of producing one additional unit of output is the marginal cost of production. This shall include an element of fixed cost also. Thus, fixed cost is considered according to the economist concepts of marginal cost, but not according to the accountant's concept. Moreover, with additional production, the economist marginal cost per unit may not be uniform since the law of diminishing or increasing returns may be applicable, while the accountant's marginal cost is taken as constant per unit of output with additional production. Segregation of semi-variable cost. As explained earlier, marginal costing method requires a segregation of all cost into two parts, that is, fixed and variable. This means that the semi-variable cost will have to be segregated into fixed and variable elements. This may be done by using some methods. These methods are: number 1, levels of output compared to levels of expenses method; number 2, high-low method; number 3, degree of variability method; number 4, scatter graph method; and number 5, least squares method. Levels of output to levels of expenses method. According to this method, the difference in output at two different points of time is compared with the corresponding difference in expenses. Since the fixed portion of expenses remains constant, any increase or decrease in total semi-variable expenses must be attributed to the variable portion. The variable cost per unit can be derived by dividing the difference in total semi-variable expenses with the difference in output levels at two time points. High-low method. This method is similar to the previous method except that only the highest and the lowest levels of output rate are considered out of various levels. This method is also known as the range method. The high-low method takes into consideration two sets of data instead of all the data. The two sets of data are the high cost point and the low cost point relating to a specific measure of output such as the number of units produced, labor hours, machine hours, etc. As the results in high-low method are based on observation of extreme data, the results may not be very accurate. Because of relying only on the extreme points, the basis computed for segregation of fixed and variable cost may not be representative of a normal situation. As such, the high-low method is generally not recommended. Though a crude alternative to more elaborate least squares, this method can give fairly acceptable results if the high and low points are chosen with careful consideration of the data. Degree of variability method. In this method, the degree of variability is estimated for each item of semi-variable expenses. Some semi-variable items may have 40% variability while others may have 60% variability. The method is simple to understand. However, determining the degree of variability may be quite difficult. Scatter graph method. In this method, the given data are plotted on a graph paper and a line of best fit is drawn. The method is explained as: number 1. The volume of production is plotted on the horizontal axis and the costs are plotted on the vertical axis. Number 2, corresponding cost of each volume of production are then plotted on the paper. Thus, several points are shown on it. Number 3, a straight line of best fit is then drawn through the points plotted. This is the total cost line. The point where this line intersects the vertical axis is taken to be the amount of fixed element. Number 4, a line parallel to the horizontal axis is drawn from the point where the line of best fit intersects the vertical axis. This is the fixed cost line. And number 5, the variable cost at any level can be known by noting the difference between fixed cost and total cost lines. Method of least squares. This method is based on the mathematical technique of fitting an equation with the help of many observations. Break-even analysis. The term break-even analysis refers to a system of determination of that level of activity where total cost equals total selling price. However, in the broader sense, it refers to that system of analysis that determines the probable profit at any level of activity. The relationship between cost of production, volume of production, profit and sales value is established by break-even analysis. The analysis is also known as cost-volume-profit analysis. Break-even analysis is helpful for a manager in many ways. They are: Number 1. It helps him in forecasting the profit reasonably and accurately. Number 2. It helps set up flexible budgets based on cost volume. Number 3. Profit relationship. One can ascertain the cost, sales and profits at different levels of activity. Number 4. It assists in performance evaluation for purposes of management control. Number 5. It helps in formulating price policy by projecting the effect of different price structures on cost and profits. And number 6. It helps determine the amount of overhead cost to be charged at various levels of operations, since overhead rates are generally predetermined on the basis of a selected volume of production. Thus, cost-volume profit analysis is an important medium through which one can have an insight into effects on profit due to variations in cost, both fixed and variable, and sales as well, both volume and value. This enables us to make appropriate decisions. This aspect will be discussed in detail in the next unit. However, it will be expedient for us to understand the meaning of and the technique of determining the break-even point. Break-even point. It refers to that level of activity where the income of the business exactly equals its expenditure. In other words, it is a no profit, no loss point. If production is increased beyond this level, profit shall accrue to the business and loss shall be suffered if it is decreased below this level. At the break-even point, the profit is zero. Utility of marginal costing. The technique of marginal costing is of immense use to the management in taking various decisions. They are: Number 1. Helps in determining the volume of production. Marginal costing helps in determining the level of output which is most profitable for a running concern. The production capacity, therefore, can be utilized to the maximum possible extent. It helps determine the most profitable relationship between cost, price, and volume in the business, which helps the management fix the best selling price for its products. Thus, maximization of profit can be achieved. Number 2. Helps in selecting production lines. The marginal costing technique helps determine the most profitable production line by comparing the profitability of different products. Certain products or activities may turn out to be unprofitable with the passage of time. Production of such products can be discontinued while production of the more profitable products can be taken up. It can help introduce new products and work as a good guide for deciding the optimum mix of products, keeping in mind the available capacity and resources. Number 3. Helps in deciding whether to produce or procure. Whether a particular product should be manufactured in the factory or procured from outside sources can be taken by comparing the prices for both. If the procurement price is lower than the marginal cost of production, it will be advisable to procure the product from outside rather than manufacture it in the factory. Number 4. Helps in deciding method of manufacturing. In case a product can be manufactured by 2 or more methods, ascertaining the marginal cost of manufacturing the product by each method will help decide which method should be adopted. And number 5, helps in deciding whether to shut down or continue. Marginal costing, particularly in periods of trade depression, helps in deciding whether the production in the plant should be suspended temporarily or continued in spite of low demand for the firm's products. Limitations of marginal costing. Marginal costing technique has some limitations as well. Number 1. Difficulty in the classification of cost between fixed and variable elements. It is tough to analyze cost under fixed and variable elements. The nature of cost in several cases may not be very clear. Moreover, some items of cost may be partly fixed and partly variable. Splitting such cost into fixed and variable components may have to be based on assumptions. Besides, some overheads may have no relation either with the volume of output or with the time factor. As such, they cannot logically be categorized either as fixed or variable. The management's decision regarding bonuses to workers, facilities to administrative staff, etc. are some such examples. Number 2. Difficult application. Marginal costing technique is challenging to apply in many firms. Its scope is highly circumscribed where job costing is the need. Notwithstanding the limitations mentioned so far, marginal costing is regarded as an advantageous technique for analyzing several business decisions. Now let's summarize the unit. Marginal costing and absorption costing are the two techniques that can ascertain the cost of a product, job, or process. Absorption costing is also termed as traditional or full cost method. According to this technique, the cost of a product is determined after considering both fixed and variable cost. In other words, all costs are identified with or absorbed into the manufactured products. Marginal costing is a technique where only the variable costs are considered while computing the cost of products. The fixed costs are met against the total contribution of all the products taken together. Marginal costing is regarded as superior to traditional costing so far as managerial decision-making is concerned. It identifies only such costs with the jobs or products which directly vary with the level of output. The uncertainty and irrationality associated with apportionment of fixed cost in traditional costing is thus avoided. The technique of marginal costing greatly helps the management in taking appropriate managerial decisions, like dropping a product line, making or buying a component, shutdown or continuation of operations in periods of trade depression, fixation of the minimum selling price of a product, etc. Marginal costing involves computation of the marginal cost. The term marginal cost is synonymous with the term variable cost. It comprises of direct material, direct labor, variable direct expenses, and variable overheads. The semi-variable overheads are also segregated into fixed and variable categories according to some suitable method. Such segregation of cost into fixed and variable categories also help determine the break-even or no profit, no loss point. A firm will start making profits only after it reaches the break-even level. The sooner it reaches this level, the better it will be. Hence, the break-even level of activity is also of considerable significance to management. Marginal costing technique has some limitations. The categorization of cost into fixed and variable elements is a tedious and challenging task. However, despite these limitations, marginal costing is regarded as a highly useful technique of analysis for several business decisions.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.